Good afternoon or good morning, depending on where you happen to be. Happy to see you here today and are getting started with options. Today's strategy, I think, is probably one that maybe when you're newer to options, after you kind of get the idea of buying options, you kind of get this idea of, well, what would happen if we sold an option? And this is one of the first strategies where we get into selling options. So it's going to be a covered call. And there's two different ways we can do it. Today, we're going to focus on the buy right. Right means sell. We're going to buy the stock and sell the call at the same time. As you have questions, go ahead and let me know. I'll keep my eye on the chat. I have also in the chat, John McNichol. I'm happy John is here. He's a great veteran of the market. Been working with John for years. As you have questions, if there's some things maybe I can't quite tackle or don't have time to get to, John will help me out answering your questions. Now, those of you that are listening to this on the recording, and I know there's a lot of you that do, when you have questions, go ahead and put those in the comment section, and then I'll go back and review those throughout the week so that you can get your questions answered as well. Now, I hope you're following me on X. I'm Connie Hill CS. John is John McNichol CS, and we'll post educational content throughout the trading day, some things we find interesting, we might decide to share it with you if we think it can be a benefit to you. So it's free, it's easy. Go ahead and follow us and pick up some little nuggets during the trading day. Let's go through our disclosures and then we will settle down into an agenda. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for information and educational purposes only. Don't consider it a recommendation. Covered calls provide downside protection only to the extent of the premium received and limit the upside potential to the strike price plus the premium received. We'll get into details on that later. Investing involves risk, including the loss of principal. We will be using the download software version of thinkorswim. It's the most robust version of it. Has lots of nice things for options traders. When we talk about probabilities, keep in mind they're theoretical in nature and they're not guaranteed in any way. Past performance of any security or strategy does not guarantee future results or success. Now, this is a series. I'm filling in for Cameron May today. Usually I'm the chat person. Today I get to teach it. And we are on buy right covered calls. All right. And so you can see the past few weeks, we have been talking just kind of about long calls, long puts. Cameron had kind of a bonus lesson last week that didn't necessarily fit in with any one of these particular lessons. Okay. But that's where we are today and where our focus will be. Amit says, it's hard for me to attend these live sessions during the daytime. Do you have a recorded set of videos I can go through in a self-paced manner? That would be an ideal thing to show you. When you're a subscriber to the Trader Talks YouTube channel, it makes it easy for you to do that. Let's go through our agenda and I'll just pop over there. I'll show you where you can do that. Okay, Anit? John might try to catch that question as well. Now we want to talk about what is a buy right covered call, because that's our strategy here today. We're going to talk about when would you get into that kind of a trade, when would you use that kind of a trade, and then the specifics for it. What kind of date should I use? What kind of strike price should I use for that kind of strategy? How do I manage that trade after I get into it? We're going to discuss all of those things and, of course, have an example or two to show you along the way. Let's take just a really brief divergence here. And I'm going to take us over here to my Trader Talks window. And once you've clicked on that little blue subscribe button, which if you haven't done, go ahead and do that, it subscribes you to our Traders Talk channel. Now on the channel, you can come over here and come to a playlist, and let's go find the playlist for this class. Because Cameron will walk you through each of those strategies. And yeah, if you're brand new and you're kind of feeling like, well, I'm in the middle of this, I need to kind of start at the beginning. Absolutely, this is the best thing to do. So let me see if I can find it here real quickly. It's going to be called Getting Started with Options. Barb Armstrong taught it for a while, so a lot of her pictures are here. but maybe some have changed over to Cameron. I'm not seeing it quite yet unless I accidentally skipped over it. And I might have accidentally skipped over it here. There's getting started with Thinkorswim. Getting started with options right here. So almost all the way down as you scroll down after you select the playlist, then getting started with options. And then when you just click on that picture, it's going to bring up the different classes that have been taught here recently. And you can go through and you can see Cameron has labeled some of these classes here. I'm going to scroll down a little bit to where it says Lesson 1, Trading Options, Building Blocks. Okay, so that would be the first one you might want to go to, and then move on to lesson 2, 3, and so forth. Okay, great question. That could be applicable to many of you because we have new folks joining us all the time. And many times we'll put a link in the description. I'll do that in my classes. I'm not sure if Cameron does or not, but I'll put in some of the previous classes that we've had more recently so that you can just click on that and get into it. Yeah, George says you can also use it, do a search on that. Absolutely. All right. Well, let's talk about covered calls. And I'm just going to ask you, and I want you to answer in the chat, how many of you have tried to trade a covered call, either in your live account or in your paper money account? How many of you have attempted this strategy in either kind of account? I'm curious to know. And I'm going to expect we have maybe some people that are a little bit experienced, maybe some people who, man, this is brand new to. Okay, after all, this is a getting started class. Well, this strategy, a buy right, covered call, this right word basically means sell. Okay, so if you hear that lingo out there that you hear right, basically that means sell. And so what it means is we are going to buy 100 shares. You have to do it at least 100 shares. You could do 200 or 300 or 250. Okay, but you have to have at least 100 shares of stock to sell one contract because one contract controls 100 shares. Now, looking to see here, yeah, Sia says do it all the time. Gregson often, right? Kylie says yes. Trade them regularly, says Tony. I am happy to see that you guys are using this strategy. Kevin says multiple times. We've got one that's a nope. Haven't done that. Haven't done many. I've done many times in a live account. Excellent, says Vic. Very good, you guys. I am glad to see that you have experimented with this strategy. George says, I like to refer to covered calls are stop wins. Well, that can be interesting terminology. Okay, so basically we're going to go out, we're going to buy some stock. And there's some different things we can look for. We'll get to that on the next slide. But when we sell that call option, it creates an obligation. It's kind of like putting up a for sale sign on your stock that says, hey, I am willing to sell my stock at whatever that strike price is before options expiration. And we have that potential obligation from the moment we sell the contract. Okay, doesn't mean it's going to happen quickly or that it's even going to happen at all. But we have to realize we have to be willing to sell the stock. So if you've got a stock that you don't want to sell, or you think maybe has more upside potential than selling a call against it, then you probably don't want to sell a call against it. Might not be the best stock to do it for. Sometimes people will treat stocks as inventory and just kind of cycle through them. And there are some people that are like, get married to a stock. Man, they are not going to sell that stock. They are married. It's their favorite one. Just don't sell a call against it. Okay. This strategy is similar to the legging into a covered call. The legging in approach, we do it with very specific timing. Maybe you buy your shares 2 months ago or even a year ago. And later on, when you think it's the right timing, when the stocks run up, maybe it's at resistance or starting to pull back, then you decide you're going to sell the call against it. Okay, so we're really going to focus on the one where we buy it right away. George has a comment here about, covered calls has similar risk profile as a cash secured put. Yeah, you're right. It absolutely does. Now, a buy right covered call, here's some things for you to think about. As I mentioned, that call that you sell has the potential for somebody to say, I am going to exercise my right and I want to take your stock away. And it's not like it's a personal vendetta, right? There's thousands of contracts out there. It's just the idea that somebody's going to exercise their right. Now, when are they likely to do that? They're likely to do that when the strike price is in the money. If it's out of the money, maybe there's not so much incentive to do so because it's cheaper to just go buy the stock at whatever the price is at that's not met yet, that strike price level, right? If your strike is 45 and it's trading at 43, why would you go exercise your contract if you can just go out to the market and buy at 43? Okay. Now, there can be events coming up that make it a little bit more likely that you could have a risk of having that stock called away. So it could be in a situation when dividends are paid, and it could be in a situation when earnings announcements are on the horizon, right? Because maybe they come out with earnings, they have fabulous news, the stock pops up, maybe it pops beyond your strike price. Well, there could be a higher probability, that will be assigned to you. Some people like to consider using this strategy when volatility and premiums are relatively higher. When is volatility higher? Well, sometimes in kind of sideways markets or maybe some bearish markets. I want to iterate here, this is a bullish strategy. Okay, it is not a bearish strategy. Volatility can be present, or maybe it's not a great deal. Okay, but this idea that premiums are higher, when are premiums higher? I'm going to kind of draw here, maybe in this gray space. Say we have a stock that's in an uptrend and maybe it kind of hits some resistance. Is it likely to have a higher premium up here, or is it likely to have a higher premium down here by letter Y? Where is that premium typically going to be the highest? Well, as a stock increases in value, typically those calls increase in value, right? And so it's more likely to maybe give you a little bit better return after it's run up, maybe going a little bit sideways before pulling back. So that's why that timing element might be important here. Keep in mind, depending on what kind of an account you do this in, there could be tax consequences for somebody selling their stock. Now, if you are using accounts or trading this strategy in an account that, say, is a tax-deferred account, we don't really get into a lot of that discussion here, but might not be a factor. But if you're in a cash account or a margin account, possibly there could be a consequence there. So you just want to be cognizant of that, making sure that you're following along with what the strategy is that you're hoping to do for that stock in that type of an account. All right, next up, what stocks could we use? What would be good candidates to do a buy right with? Okay, stocks that appear to be in a neutral or sideways trend. Now, is this a sideways trend? No, of course not. Is this a sideways trend? Not exactly, right? It's making lower lows and lower highs. So we want it to be at least neutral, okay? And there may be some instances, well, maybe there's a little bit of an uptrend, but it's just maybe not a steep uptrend. If a stock is on a real steep uptrend, some traders might go, I think there's more upside potential on the stock. Maybe I'll just hold the stock, let it run, not sell a call against it. And so it kind of fits in a little particular niche, kind of depending on what the stock is doing, what the market's doing. It says maybe timing-wise, sell a stock as it's approaching, oops, that's ugly, the resistance area. Okay, so basically it's run up, it's peaked, maybe it's up here at resistance and getting ready to fall back. Okay, that's when we might want to time this. We could look for a close below the low of the high day. Some of you are familiar with that. We want to target stocks that have a high trading volume. Okay, if your stock is only trading 250,000 shares a day or 500,000 shares a day, there may not be a lot of liquidity in those options. They might not be used very much. Okay, we want to stick where there's pools of contracts. Okay, you want to be a little tiny fish in the sea of those contracts. We want to trade options that have the higher open interest, and we can look at volume there as well. And then when we see this, we're likely to see tight bid-ask spreads. What does that mean? The difference between the bid price and the ask price is smaller, okay? Maybe it's going for $5 by $5.10. Maybe it's selling for, $125 bid price, $135 ask price. Okay, so just kind of a small little margin. And the one that we're going to look at, in fact, I've got a few outlined that we might take a look at here, do have higher trading volumes. Now, this isn't on the slides, but I do want to mention it. What is a good price? Those of you that trade this strategy and have done it a lot, is there a price range that you target? Okay, let's take an example of say Costco right now. Okay, Costco is, I think, over $1,000. Okay, that is a high price to pay. When we go and look at those options, they might be liquid, but to tie up 100 shares of stock in Costco is going to cost a chunk of change, and it might not be appropriate for everybody's budget. Okay, so some people may have a range that they like to use for this particular strategy. Sometimes it would be $100 or less. Your range might be a little bit different. Those of you that are chatting in here, I'm curious to see what you said here, as far as the price that you will target. George is talking more about the delta, which we're going to get into as far as which strike price we might target. Tatiana says, what is the bid and ask difference the best? The tinier it gets. Let's go look at an example here. We're going to head over to Thinkorswim. I just got the SPX up for now. Let's look at a stock real quickly here. We're going to use as our first example, which is Cellulose. Okay, these guys make, I don't know if you'd call them energy drinks, but maybe health conscious flavored drinks, maybe to restore your, I'm trying to think what I've read on it before, restore your something or other if you're out exercising. Okay, clearly don't know as far as Cellulose where their niche target is. In any case, canned drinks, you probably see them in the supermarket all the time. Now, what's the trend on this stock? Well, the trend, it has been a little bit bullish. This is a 20-day moving average. So it was bullish for a period of time, and just as kind of looks like it's peaked out. Maybe there's some resistance there about 38.5. Looks like maybe it ran up to it the other day, but didn't stay above it, dropped back down. Today it's running into it again. And then one thing that I think might be helpful to some of you is if you use this MACD histogram study. What it shows us is kind of where's the flow of momentum. Is the momentum above zero and building? So when it's like this fluorescent green color, it's building. When it's this darker green color, which is even a little bit hard to see with this black background, when it's the darker green color, it means that, yeah, it still has positive momentum, but what's it doing? It's fading. It's dropping off. And so that might be a help for you when you're technically looking at something to say, okay, is it maybe good timing for this? Now, you'd want to make sure Cellulose meets your criteria for what you look for in a stock, okay? This one, we can see trading activity. It looks like maybe the average right now is about over 7 million a day. Is that likely to lead us to option prices that are more liquid? Yes. As we look at our example here, we will look at the bid-ask spread here. So this could be maybe the right timing. Now, as we come over here to the trade tab with Cellulose, today it's traded over 2.6 million shares. Day is still young. Probably is going to trade a lot more as the day goes on. It has weekly options, and sometimes we can find liquidity in those weekly options. Today, we're going to stick with the June 20 options on our examples because they're the weeklies don't really have a ton of open interest. But a trader might use a window between 20 to 40 days worth of time, 20 to 50 days worth of time, for which they would like to sell the call. So how many possibilities are there here? Well, here's one that's 24 days. This one's 31 days. This one's 38 days. This one gets a little beyond our range, but it's not out of the question, right? This July option has 59 days. And so these might be the ones that many traders might look at first. Could you sell it further out? You could, if you wanted to. What would be the advantage there? Well, the advantage would be bringing in more premium because you're selling a lot more time. The disadvantage is that this strategy uses time decay as an element, and we want to use time decay to our advantage of a seller, as a seller of an option. And so if it's clear out here, in these later months, our theta value is going to be much smaller than if maybe we target something in this 20 to 40, 20 to 50 days worth of time. Now, as we, let's clean that up. Let's go and open up our June 20 options. These are our monthlies, 31 days. So it's just kind of in the sweet spot there. I'm going back to the chat here. Those of you that are targeting specific stocks for a covered call strategy. Tony says, I use $50 to $150 as far as the stock goes. Life in the Fast Lane likes a range between $50 to $75. Yeah, absolutely. Your preference might be different than Life in the Fast Lanes and Tony, right? Your range might be a little bit different. You may have a bigger portfolio where maybe you can allow yourself to buy more than 100 shares or at least 100 shares on a stock that maybe is a little pricey. Okay, like I said, Costco. Now, going back to the question about the bid-ask spread. When we're talking tight, what is tight? Okay, let's look what we have here. Let's just focus on these June options. And I'm going to come down here to our range of, say, 30-ish delta. Okay, some traders like to look for a 30-ish delta. Doesn't mean you have to, but we've got what? We've got a 37 here. What's the price on this? 141 by 146, 5 cents. Ooh, that should be delicious to you. You should say, ooh, yum, that's a tight spread, right? Stock doesn't have to move a whole lot for you to make up that 5 cents. But if it were, say, 20 cents or 30 cents, yeah, that's a lot more on a stock that's only a $38 stock, okay? Here's a 34 delta. $1.26 by $1.30, that's only 4 cents. Oh yeah, we're loving the liquidity here. Now, the one thing we're going to notice here, here's my open interest column. Here's my volume column. Remember, volume's just what's happening today. Open interest are the balance of contracts that were sitting out there at the beginning of the day. All right, so some of these have a lot of activity. So look at this one. The 40 strike price has over 24,000 contracts out there. That's sweet, right? And today, 338 new contracts have been initiated. That's a lot. That's a tiny little fee in a big sea, or a tiny little fish in a big sea of fish, okay? Down here, the 29 delta. It has 4,350 contracts. That's nice to see. This one here with the 35 delta has 15 open interest contracts and 14 today. So that'll kind of be incrementing tomorrow, more likely than not. But is that enough to feel kind of safe? If you're somebody that says, I want to sell the premium, I'm not bent on my stock being called away, but I'm open to it. I'm not married to it. When you have so few contracts, then it could be more likely that you're assigned and your contract gets picked versus if it's in a pool of a lot of contracts here, okay? So the one that we're going to go with here, we're going to go with, well, what we might consider, we could maybe consider the 38 strike because of the new volume that's in here. It would be over 100 contracts. And in our case, for our strategy, we're just going to do 100 shares and sell one contract, okay? So that might be a consideration. This one that's now a 30 delta, that could be a consideration, okay? If we sold this particular one, the 42.50, looks like would gain $1.04. Now, some people will look at that as maybe buying the stock at a discount, right? Because essentially we'd be buying the stock for $38.47 and we get a little kickback. I shouldn't call it a kickback. We bring in a little bit of premium, and it lowers kind of what we might think of our net debit for purchasing the stock. So instead of buying it for $38.50, what would be reflected is, okay, $1 off of that, that's going to be $37.50, and 4 cents additional. Okay, then we've got 46 cents. Okay, so that's how we might look at it. Now, there looks to be a survey in the chat. And you guys know from time to time, we'll put some surveys out there. It happens randomly. I don't know when it's going to happen. John doesn't know when it's going to happen. But what we like to do is kind of take your pulse for this class. Now, our class isn't over, clearly, right? We got quite a bit of time left. We're going to look at some examples. But if you wouldn't mind, if you click on that link and just let it sit in the background, and then when it's time for you to go or the class closes up, then go ahead and fill out the survey then. Now, I like easy surveys. I get annoyed at really long surveys, but I do like easy surveys. And this has 2 questions. You fill in the radio button, plop, plop. On a scale of 1 to 10, what are your feelings, right? You go ahead, you just mark it, you're done. So it's like a 2-second quiz type thing, or 2-second survey. But there are a couple of places for you to put in and respond to some questions if you would like to. I always encourage you as well to say, if you want to communicate something with your instructor, today that would be me, of things you might like to see coming up, go ahead and let us know. Or maybe you're having a problem with something and you're like, I'm having this little problem. Could you address this in a class coming up? I love to incorporate that kind of information into the classes that I teach. So I'm going to encourage you to use it for those purposes as well. Okay. John will repost that again before our class is over. And so, just go ahead and select on that. Yeah. Desert Saguaro says, can you talk about what happens when we are assigned? Absolutely. And we're going to get into this a little bit. I'm going to hold that thought for just a moment because it's going to bleed into some information we're going to cover in just a minute. Okay. Now, George says, ideally less than 5% of premiums. And I think what George is answering is what's a nice bid-ask spread. Okay. So some people will love a 5% spread. Some people might draw their line at 10%. If it's at 10%, possibly a couple of things. One, there's a lot of volatility, and so the bid and ask prices are spread out. So you take that into consideration. Or there's not a lot of trading activity on it. If there's not a lot of trading activity on it, then we could see bid-ask spreads being wider because the market maker, they don't have a lot of contracts to make their profit, so they have to spread out the bid and ask. How would you calculate that? Let's bring up our little calculator here, and we'll do it on the 4250, the one that we're considering here. Okay, $1.04 by $1.10, so there's a 6-cent difference on that premium. I've told you that's lovely. We love to see that, right? We're going to divide that by the ask price, which is $1.10, and that's going to give us a percentage. That percentage is what we're looking at. What is the spread percent? Looks like it's about 5%. 5% is lovely. 4% is even lovelier. 1% is even lovelier, but not as easy to find. There can be some things that trade super liquid options that maybe are 5 cents difference or a few pennies difference. So just keep that in mind. So the smaller it is, the better. Some people will draw the line at 10%. Doesn't mean you have to draw it there, but that might be something for you to consider. All right. Tatiana says, when you buy an option, the ask price is changing. How does it affect my option? Well, it doesn't. As a buyer or a seller, it's just going to change, right? Maybe you sold the option in the case we're talking about here. And then if you're buying the option, it's just going to reflect changes in the price of the option based on what's happening with the stock. Okay. Now let's show you how you would put this in. Okay. Some of you are veterans at it, man. You know this already. But we're going to suppose that we want to buy 100 shares of Celsius. We could do more, but we're just going to do one for our example here. And then we're going to be on our strike price here. That's the 42.50, and we can be anywhere on this line. Okay, we can be at open interest, we can be at probabilities, we can be at the ask price. But what we're going to do here, get on the right one, Connie, we're going to do a right mouse click and we're going to say buy, and then we're going to pick the strategy. On the Thinkorswim platform, it's called a covered stock. Covered essentially means that you own the stock. If it were, well, we'll just leave it at that. Okay, covered means you own the stock. Naked's a different term, which means you don't own the stock and you're selling an option. Today, it's covered because we're going to own the stock. Now, notice what our net debit is, $37.38. Is that what the price of the stock's going for right now? No, it's going for more than that. Okay, that's where you notice your net debit is a little bit lower. So you're kind of like, oh, well, I'm buying the stock. Kind of the way to think at it is, you know, maybe you're buying it at a little bit of a discount because of that. Now, when we go ahead and process this, which we'll just go ahead and send it through. Notice we've got 100 shares of stock and 1 contract. If we were buying 200 shares, we could sell 2 contracts. If we're buying 300 shares, we don't have to sell 3 contracts. We could sell 1, 2, or 3. Okay, it's just that you have to have that minimum of 100 contracts for every 1 contract you want to sell. So 1 call contract. Okay, we're going to go ahead. We're going to send this in and let it hopefully get filled for us. There we go. We got filled at $37.36. Nice. We got a nice little discount on whatever this is trading at right now. Let's talk about managing the trade, because that's going to get into what if we get assigned. Okay, let's go back here real quick. Couple of things, couple of details to go into. Strike selection, I talked a little bit about. Many times you're choosing something out of the money. We talked about, you know, say some traders like to sell a 20-something or a 30-something delta. You could sell a 40-something delta, okay? I would say probably the most common range is lower 40s to higher 20s. Okay, you could be a little bit different. You don't have to meet anybody's mold. Typically, we'll look for those 20 to 50 days out. We talked about that. And then position sizing. Some traders like to position size based on what that net debit is. Some people like to do a position sizing if they were to take a max loss on the position. Well, where would you have a max loss in the position? If the stock went to 0. Okay, that's a lot to position size for, okay? And, you know, hopefully you're working with a stock that you don't think is going to take a nosedive anytime soon, right? It's just kind of moving along a little bit more. It's bullish, but it's a little bit more sideways. Okay, when would we get out? Okay, let's talk about the first one. You can, if you want, at any time after you sell it, you could go buy it back. We just sold it now for about $1.04. What if by the end of the week it's sitting there and we could buy it back for 50 cents? Some people might consider doing that, right? They may say, Matt, if I get half of it in the first week, good. Let me lock in those gains. Let me go buy it back. Let me remove my obligation to have to sell it to somebody and look for another opportunity to sell. Okay, and you can use a different percent, 80%, 90%, whatever that percent might be. One thing we can do is called rolling. And rolling essentially means we would go buy back that option that we sold and in the same motion, sell a different strike price. It could be for the same month. It could be for a different time frame. It could be for a weekly or a monthly. It could be for a different strike price. It's just the idea that you feel like, man, I've kind of got what I wanted out of this option. I got a chunk of it, and now I want to sell again. Okay, so you do that. It's called rolling. If it's confusing to you to do that roll, just do it in 2 steps. Buy it back, sell your next one. Okay, it's not going to make any difference in terms of pricing. It was a big deal when initially, before the price or the commission for kind of a flat rate commission for selling any option, then it was really advantageous to do it together. The way that the pricing works right now and commissions, then maybe not so much. Now, you could also close the entire position, which means buying back the short call and buying back the stock altogether. When would you do that? Well, what if there was a change of sentiment in the stock? What if the stock started to downward trend and it met your conditions for getting out of stock ownership? If you're thinking, man, it's formed a lower low and a lower high, it broke some significant support, and say typically you don't stay in a stock of that nature, yeah, you might say, need to get rid of the stock. Let's go buy back the call, first order of business, then sell the stock. And now we're going to get to what the question is if we're assigned, okay? If you hold that option to options expiration and the call is in the money, then you're likely to be assigned. And that essentially means the broker will take care of it. It doesn't have to happen on options expiration day. It's more likely to occur that last week of an option's life. And so some people will say, well, I want to get out of that position maybe 4 to 10 days out, so that maybe if they don't want to be assigned and have the stock called away, they don't have to. Okay. It's likely that you would be assigned, but it's not absolutely going to happen. So if you get assigned, basically what happens is you'll lose your stock and you go into your account and you're like, oh, my stock is gone. Oh, I was assigned on it. All right. When we're talking about that, typically you're going to get an email notice as well. Okay. But is it a bad thing? Not necessarily. It's not necessarily a bad thing at all. Let's run a little math here. We're going to go back to Thinkorswim. We're going to open up our calculator here, clear it out. What did we get in the return for the one that we just sold here? Okay, we had to tie up about, I know the price is changing here a little bit, but about $3,850 to buy 100 shares of stock. What was our return on that? Okay, well, let's suppose that we did that. I think we got like $1.06 or something like that, right? So it lowers our net debit. And in this case, as you're monitoring your position, it's also going to keep track of what's the change in the price of the stock, what's the change in the price of the option, just like any other option trade. Okay, it's going to be tracking those values. Okay, what did we get on it? Let's say that we had $1.06, which I think was pretty close to what we sold it for. So let me put in here 1.06, and we're going to divide that by how much money we had tied up, okay? Which is going to be about $3,850-ish. That in there, $38.50, okay? Didn't we? Let's try it again. $1.06 divided by $38.50. And actually, 106 because we multiply by 100 shares, divide that by the actual cost, $38.50. And I say coming back at a screwy number there. Generally, it's going to be a small number. Okay. Sometimes it might be in the high single digits. Sometimes it's going to be in the low single digits. 2%, 3%, 5%. Okay. When you're going out of the money. If you're going at the money, then of course your premium is more and it could be a nicer return. And again, I'm not sure why that's not doing it. We'll try it one more time. 106 divided by 38.50. There we go, 2.7%. Okay. Now, if you're working with a stock and you're like, well, on average, it goes up more than 2.7%. Maybe you go back and you track it. Some traders will do that and they'll go, oh man, look, this thing is off to the races. I got 10% last month and it grew 8% the month before. So far this month, it's up 5%. So some traders might say, man, if I've got a lot of growth stocks and they're being very bullish, they might decide not to sell a call against them. And that's why we're looking for something maybe a little bit more sideways, but still a stock that we might be interested in. Let's see, Jupiter says, what part of the institutional ownership have on premium? Premium's more a function of buying and selling. Is there a high demand for the strike price or not? Okay, it's more that. John's helping you out here as well. A cautionary tale from Jack says, I once had my stock assigned days before expiration. I never intended to have the stock assigned. I was in the non-qualified account and it triggered a gain that you really didn't want. Kind of goes back to the idea of don't sell a call against a stock you really want to hang on to. Don't go stick a for sale sign on it, right? You're not going to put a for sale sign on your house if you aren't serious about selling it, right? It's not like you throw it out there and go, I'm just bluffing, guys, right? So, and it's the same thing with the stock. I want to show you another one here. We're just going to look at the chart real quick, and then we're going to look at the numbers, okay? So let's look at this one, CEDG. Now, this is a stock that just recently had some good earnings, and its trend started to turn to go bullish. Now, this is a 20-day moving average. The MACD has run up, and what's it doing? It's kind of rolling over again. It's starting to show, okay, there was some bullish momentum, but it's starting to pull back. We go in and sell a call at this point. What's our expectation? Our expectation is that the stock price is going to drop a little. Okay, so it wouldn't be as high as it might be if we were buying it right at this minute. But our option, we sold a little bit higher, and it should be shrinking in value as well, right? Because as the stock price pulls back, the price of that option should pull back. And we also have time decay working in the favor of the seller. Okay. Do you have to use the MACD on it? No, I'm just suggesting this might be an additional tool to help you decide, is the stock running out of some momentum for this run? Okay. Now on this particular stock, it's traded over 2 million shares today, but there's only some strikes that are super liquid. Okay. That's what I want to point out to you. So we've got a 38 delta. Only has 14 contracts. We have a 35 delta. It has no contracts. There's a 32 delta. It has 2,200 contracts. And so if you were interested in selling a call here, you're going to be a little bit more limited simply because there aren't a lot of strike prices with lots of volume and open interest. Okay, so that's going to guide your decision making as well. Okay, say you're in the trade. Is it bad to get called out? No, not necessarily, because I'm going to go back to our Cellulose trade. Back here to Cellulose. And we got the stock, and we wouldn't be called out until the price of the stock gets to what? 42.50. Well, that means we get the growth in the stock from whatever we bought it out, 38.50-ish, whatever it turned out to be, to 42.50. We get that total growth on the stock, plus we brought in that premium, and that's what you might use to calculate your total return on that if you were called out. So it's not a bad thing to be called out, but you do want to use your stock rules if the stock maybe drops, breaks through support, isn't looking like the way you would want it to look. If you own the stock overall, right, then you might consider getting out of that position early. Now, I'm going to look and see what kind of questions we might still have left in the queue here that maybe we haven't had a time to look at. Big funds seem to be on the move in a herd. Okay, Jupiter's giving us a comment on what's going on right now in the marketplace overall. All right. One last thing here. Know that you're going to be restricted beyond the strike price of your stock. Whatever you sold, the 42.50, we're not going to get the stock gain on that. We're going to be capped of 42.50. Okay. And so that's what this little warning is here about limited profit potential. If stock goes beyond it, you still made the growth from whatever we bought it at up to 42.50, the strike price, but we miss out on the growth beyond that. Well, can we get back in the stock? Sure, we can absolutely get back in. The downside here, any premium you collect, like in this case, $1.05, it helps hedge if the price of the stock goes lower than that. But if the stock moves significantly lower than that, then it could be putting that entire position into a losing scenario rather than a winning scenario. And keep in mind, you can always be assigned short options anytime. After you've sold it, any stinking time, okay? Regardless of what the in-the-money amount is, or even if it's out of the money, you still could, in some scenarios, be assigned. All right, you guys, that was our lesson on covered calls. If you haven't been using this strategy, I want you to practice it, okay? I want you to go out and practice it in your paper money account, of course, just so you kind of get the hang of it, Okay. And follow through. See if you hold the stock all the way through where you thought it was, or through expiration date. See if you get called out sooner than that. Oh, if you did get called out sooner, what kind of percent gain, if any, did you make on it? Right? Go through and just do several iterations of it. Some of you mentioned that you're doing it, right? It's one of your strategies that you do a lot of, which is fantastic. But I'm willing to bet you did some paper trading first so you could get the knack of that strategy. And so I'm just going to encourage you to do that. Now, coming up next is going to be long options. Okay, Brent Morse teaches that class every week. He does a fabulous job. I know, because I'm his chat person out there. And so he will be bringing that up next. Now, I will be back later today at 4 Eastern. We're going to be teaching selecting an option strategy. And we're, just so you know, I'll give you a little hint since you're in here, we're going to talk a little bit about covered calls as part of our discussion there. All right. Take a 15-minute break. We'll see you back here. Thank you, John, for your help today in answering questions. If you haven't filled out the survey, I'm going to encourage you to fill out the survey for us. We love you forever if you'll do that. And then we'll see you right at the top of the hour. Thanks, everybody. Have a good afternoon. Bye-bye.